You're thinking about the big renovation job, whether it's a kitchen addition, maybe a second story, and you've got this whole process in your head, but at what point of the process are you thinking about paying for it? That's right. Today we're going to talk about financing your home improvement project with my friends from Rocket Mortgage. We're joined by Chris Osterlund and Brian Baumann of Rocket Mortgage. Brian, you've been in this industry as long as anybody. Can you give the audience the history of how long you've been here?
I'd love to. I bet you I am the longest running mortgage banker in the state of Michigan.
Could be.
30 years. Not only have I been doing this for 30 years, by definition, just for the time length, I'd consider that being an expert, Webster's definition.
Correct.
All right, I graduated college December 95. Gary Gilbert was starting a new division at a company called Rock Financial. Him and his brother formed Rock Financial.
Gary Gilbert and the famous Dan Gilbert.
And the famous Dan Gilbert, 1995. So I went on an interview with Bill Emerson, Dan Gilbert, Gary Gilbert, and was hired. Started January 2nd, 1996. And I've been there ever since.
30 plus years.
30, and it went by so fast. And it's exciting. Now think about it. This company went public twice. Twice it went public. Once when it was Rock Financial, being Quicken Loans. Dan bought it back.
Amazing story, by the way.
Amazing
and
story.
back, in fact, because we're all from Detroit, it's just an amazing win for everybody, including the whole city. So you've been there 3 decades.
3 decades. I've seen it all.
Hey, did you ever track the rates from like 1996, how they've gone up and then down, like a roller coaster? Or is it, give me your like curve of, or the bell curve of what's going on here?
You think, well, to go back, the only place you got a mortgage back then was Standard Federal Bank, Credit Union. That was it.
Yeah, right. Big banks.
Big banks.
And it took forever.
It took forever. And it seemed like a lot of stuff back then was done on handshakes even. But at that point, Dan Gilbert's idea, and his idea to start this mortgage company was when he was flying into Detroit, and he would see all these homes. And he was like, all those homes need financing. I got to get in on this. That was his idea to start his mortgage company, right? So interest rates when I started were, I'd say 13.5%. 13.5%. That was back in January 1996. And what caused interest rates to fluctuate was the first time we saw a big decrease was the dot-com bust.
So that was in the early 90s, very early 90s, like 92?
Nope, that was late 90s.
Oh, I apologize.
Late 90s.
I'm aging myself.
Yes.
Late 90s.
Late 90s, dot-com. And then we started to see interest rates. The loan product a lot of people are doing were 1-year ARMs. Because
what
interest
is an
rates
ARM? Just for the audience to understand.
ARM's an acronym. It stands for adjustable rate mortgage.
Adjustable rate mortgage. Okay,
Yeah.
so it's not a locked-in number. It can go up or down.
It can go up or down. So let's say you're locked in for 1-year ARM. That rate would stay the same for that 12 months.
So when you were doing the ARMs, the adjustable rate mortgages back then, what years were that?
96 through 99.
Okay, so 96 through 99, you were doing adjustable rate mortgages, and the rates.
But let me tell you why.
Let
me tell you why we were doing adjustable rate mortgages. Because you were able to take advantage of a lower interest rate for that time, which would be half the cost of a 30-year fix. Let's say that was at 11 or 12%. So you get 7 or 8%.
Average homeowner had 11, 12% mortgage. You would get a hold of these homeowners and say, listen, we can give you into an adjustable rate mortgage and take your $1,000 a month mortgage payment, for example, and cut it basically in half?
That's right.
Wow.
And that's what that's what we would do. And my job for my clients would be we look after them. We look after their loan. Is there another opportunity out there? So then, in 10 months' time, we give them a mortgage analysis.
And what would a mortgage analysis actually do?
Well, Mr. Jones, Brian Baumann with Rocket Mortgage, do you remember me? Yeah, of course I remember you. Let's look and see where rates are today. What are your goals? Are things changing? And that's when these home improvements would come up, for instance. Brian, I was thinking about redoing a kitchen. I was thinking about adding a pool, for instance.
Okay, so people can use the equity from their house or their good credit and you get money to pay for that. So that's what you've been doing. You've been there 30 plus years. Chris, how long have you been at Rocket?
Not 3 decades, but about 2. So
I don't think he is 3 decades old. What do you think?
Well, my 4 kids would say otherwise, but
That's true.
But yeah, no, I started in 07, very early in 07.
So 2007. And then you've been with Rocket that long too?
Rocket the whole time, yeah. So when I started fresh out of going to college, and then shortly after that, obviously, we had the big 09 credit crunch. All the credit lines froze. Second guessed whether or not it was the right business to get into shortly out of college.
Timing's everything, right?
Yeah, timing's everything. But helping people own homes and finance their homes is never going to go away. So it was for me. It was pretty easy to stay confident, in the direction. But it was a great decision.
It's interesting. You've been there 20 years. You've been there 30.
30.
It seems to me that says something about the company. To have employees that have been there that long,
that's a good point.
There's a ton of people at Rocket that have been there that long, isn't there?
It's the culture. It's the belief.
Is that isms, that book?
I mean, we are surrounded by the isms. Wouldn't you agree? That's our culture.
Well, that's where Dan and Bill and all the original guys, Gary, Lindsey Gross. I mean, all these guys that have been around forever. That's where they built the base of the company. It's like it's like the cornerstone, as they would say.
Is that DNA still in the company today?
I think it's more.
It's crazy that it is as strong as it is. Bill has always been a champion of the isms.
Mm-hmm. Bill Emerson, right?
Bill Emerson.
My mentor.
Everybody goes through Isms Day, which is a day where we bring people in and we talk just about the culture, the philosophies, the isms, and how we use them to guide all the decisions that we make. So that way everybody's, philosophically aligned. And it's still very important.
So, here we are, it's 2026. The real estate market's in a little bit of flux. The interest rates have peaked. I think they're poised to go down, and we'll figure out what that is. But walk me through what today, if a homeowner wants to do a big renovation job, but they don't have the cash on hand, and they need to have financing options. So they're watching this podcast today, and they say, "Oh my God, Rocket Mortgage! I should call them." So you get the phone call, either one of you, and homeowner says, "I live in Metro Detroit. I have a house that I have a locked-in mortgage at 3%. Mortgages are at 6 and 7% now. I don't want to refinance to a higher rate, but I need money to cash out. I have equity. I want to pay for my kitchen addition. I want to pay for my second-story addition." What's your first point of contact with the homeowner? What is the conversation like?
Man, so I'll start us off, and then Brian.
I'll chirp in.
But I would tell you that interest rates are a tool to get what you need with a mortgage. They're not the end all be all, and they're very important. So you can't minimize that.
Of course.
But if you have a $40,000 mortgage at 2% and you need to do a $200,000 renovation, the 2% mortgage is probably gonna go.
Yeah.
And the reason I would say that is because if you went and got a second mortgage, like a home equity loan or a line of credit, you're not going to get as good of an interest rate as you would on a regular mortgage. So if you had a 2% $30,000 or $40,000 loan, but you had a $200,000 loan at 8, 9, 10%, your blended rate between the two, you use the law of weighted averages. The weighted average would lean more towards the bigger loan with the higher rate.
Okay.
So you're gonna have a blended rate that's higher than a 6 or a 6.5% you could get if you just redid the whole thing and put them all together.
Okay, so let me stop you right there. The average homeowner, what you just talked to me about, almost could be like fuzzy math. They don't
100%.
understand it. So you need to communicate with the homeowner in a way that they're like, "Oh, I get it." So let me paint the picture, and then you tell me how we're going to give this homeowner a roadmap to a successful finance project for their home improvement.
Yeah.
I have a house, $500,000 value. Okay, I owe $250 on it, and I need $100 to renovate my kitchen and fix the house up.
Yeah. So with us, what we would end up doing is we wouldn't expect them to diagnose the problem and the solution. That would be where having somebody that you trust that understands all of that stuff is important.
Which would be you guys.
Which would be us. So we would sit down and look at what exists on the house now, what the loan looks like, how much money you need. And we would walk you through a plan and say, well, look, we can do a home equity loan, or we can refinance the whole thing. Here's what the monthly expenses are. is this affordable to accomplish what you're looking to do? Because at the end of the day, affordability is the most important piece.
You want to be deal makers, not deal breakers.
Yeah.
So that's where I'm, and that's what I want to clarify for homeowners. So Brian, if the homeowner has a house worth $500,000, they owe $200 on it. There's $300,000 equity. They want to spend $100 to renovate the house and fix it up, and that $100 makes the house worth even more now. And their credit's decent, but they have that 3% mortgage. Interest rates today are 5, 6, 7%. The equity line. Where are you taking them? Which is the best path?
First I always ask my client, what's your 5-year plan? How long are you going to be in this house? Right? How long, what's your commitment to?
Well, I want
to
be in this house. I have kids 10, 11, 12 years old. I want to in the house. I want to be in the house through high school, going to college. So we've got 10 more years.
So you have a 10-year run in this house. Interest rates at 3%. We don't want to touch that.
Correct.
So then we're going to start talking about their plans. Have you talked to an architect? Have you talked to a designer?
Right.
What are your plans? Are you going to be knocking walls down?
Yeah, so I'm adding a new kitchen addition. So the house is going to get bigger.
So you're going to change the kitchen. You're going to change the footprint of the
correct.
property.
And
so this is a major reno.
And I wanted to make sure I have the money before I waste the architect's time or the contractor's time. I need to make sure I can financially afford an idea that I have. So I'm first going to my banker, trusted banker, which is you, Rocket Mortgage, and I need you to tell me what I need, where I got to go, and then I'll go out to the marketplace with the contractors and tell them, here's what I have to spend. Can we make it work?
And by the way, that is the first step. A lot of people, they'd run with their wives on a Saturday night, they'll do a brunch, they'll have some mimosas, they'll do all the shopping and do everything else before they talk to the finance guy. You need to talk to the finance guy before.
Isn't that like real estate agents say, if you're going to go look for houses, make sure you're pre-approved.
Call us. Call
Right?
us first. To do that first. Yeah. I'd like to dip my toe in the pool.
Okay.
To get an idea of, so $100,000. You want to do all these things. What do you think it's going to cost per month? If they tell me 200,
easy math. Then.
So, well, no. I said, what do you think it's going to cost you? If they say it's going to, I'm looking to spend $200 a month. Well, we're gonna have another discussion. So they want to give you
payment. You're going to.
I want to know what they think. What do they think this is going to cost you?
Okay.
If they're way out of the marketplace, I got to bring them back down, break them down to the reality.
They Google kitchen edition and they Google it for their zip code, and it comes up to $50,000, and they're off by $25,000.
Let me ask Chris. Chris, do you get a lot of clients that call up with these crazy interest rates that they're pulling off the interest rate? I get people that call me that think they're still getting 2% interest rates. And they're just like, Brian, can you match this 2%? I'm like, what are you talking about? Don't give them your social security number. Don't give them your date of birth. It's not possible. You get that?
Are there scams in this industry?
Oh my gosh, there's scams everywhere in the world. Wake up, Adam.
Yeah. Clickbait's everywhere.
Be careful out there. Go with your trusted mortgage banker at Rocket Mortgage.
At the end of the day, somebody has to understand affordability, like you were saying. And so if somebody needs $100,000,
I like that. Understand affordability. I'm going to write that down.
If you're looking at a $500,000 value,
and
you just tell somebody, listen, you can get 80 to 90% of what the house is worth. Over 80% changes some things. So let's just start there. So if you have a $500,000 house, you can have loans against that house for as much as $450. But let's look at $400. So if you owe $300, the max you can do before things start to get a little dicey and change is $400. So you got $100,000 to play with.
And that's what I'm thinking in my head.
Exactly.
To do the addition with the kitchen is $100,000.
So I tell somebody, listen, you're probably going to be in the range of $700, $750, $800. I just give them an idea and say it's going to be in this range.
$750, $800 per month, not $800,000.
No, $700-800 a month. And sometimes I'll just test the waters, like Brian said.
Not the whole mortgage.
Yeah, just a loan that you're going to give them. And I sometimes I'll just, everybody has a little different style. So for me, I'll just test the waters and say it's probably going to be about $700-800 a month. What do you think? And they say, you know what? For $100,000, I go, yeah, change the kitchen, blow it out, beautiful new renovation. $700-800 a month. What do you think? And if somebody's like, yeah, that's about
okay.
Right.
So if someone says that falls within the range,
yes,
and then they say, okay, this is great. Do you have them fill out an application? What do you have them do?
Yeah. We say, hey, let's take a further look. Look, if it ends up at 825 or 725, it's in the range.
Before we get into the application,
Right.
I want to interject real quick. Before we get, because he's going to talk about the application process. So what we were talking about was an idea of payment.
Correct.
And see what they're comfortable with. And I brought some rates with me to give ideas and stuff. But we have different types of programs. Whether you want to be more aggressive with the payment, because what we would do is find out how much money they make. Everybody tells you how much money they make. But they don't tell you, like, what is your W-2? Let's say I made $100,000 last year. Well, you did make $100,000, but that FICA, that guy that's on your check, you get that check, that copy, they take their piece, right?
Everyone does.
Everybody gets it. So you're really bringing home after maybe $70,000.
If you're lucky.
If you're lucky.
Right.
You know, so you make a lot less. So I kind of give them an idea of this is what you're bringing home. So for the people that want to get more aggressive, you can fix that over a 10-year period, 15-year period, 20-year period.
Pay a little bit higher.
Pay higher, give them an idea. This is the principal. This is the interest. You know, my go-to would be you can always pay more, but
Correct.
you can't pay less.
So start at the lowest and know that you can go up.
So, but that's why I go, what is your plan? Like you said, I've got kids. I'm going to be here for 10 years. So if you got kids, you're going to have some expenses coming up.
Right.
Chris can tell you about that. He's got 4. He's got his own football team. You know what I mean? But, you know, travel sports. Every time I talk to Chris on the weekends, he's at a gymnastics event. These things cost money. They cost money. Kids cost money. You got kids?
Yes.
How many do you have?
2.
Oh, my God. You're telling me about
My son,
Max.
Yeah, of
you know?
course. Everything's, look at, life is not cheap.
No, so it's not cheap. But you know what's fun?
Yeah.
A kitchen renovation.
Well,
We talked about this.
kitchen renovations are fun when you make your first meal in it.
Yes.
During the process, it starts fun.
No.
About 21 days in, from
No.
experience,
Yeah.
you start to raise an eyebrow. 36 days in, both eyebrows are
yeah.
raised. 45 to 90 days in, guess what?
You're yelling at your contractor.
You want to fire him.
Yeah, you hate
And
your
then
contractor.
120 days, and you've had a few people over, and everyone's bragging about your kitchen.
Yeah.
You take that deep breath.
What about the first Christmas in your kitchen, right?
Even better.
First Hanukkah for you.
Here you go.
Yeah.
There you go.
8
Yeah.
days.
Yeah.
Yeah.
That's when I become Jewish. I spun
Every
the
day's
dreidel.
Hanukkah for me.
Yeah.
So
Which
we
is
try
fun.
to try to stick with that payment range. And
So we got choices,
you know,
right?
Yeah. You give it a payment range
got
that's on just a
choices.
30-year and say, you know, is this kind of in the range of what you had in mind?
Okay.
And then you start to paint the vision like you talked about of like, okay, what does this do for you and your family? Is this in the range, right? And once you get to that point, then you look at, okay, let's get into the nitty gritty. Let's look at your income. Let's look at your assets. Let's look at your credit. Let's just get an idea of what
take
it
them
looks
through
like.
an application.
Yeah, so
Let's take them through an application, Chris.
Yeah, so you when you talk to anybody about a loan, you usually look at the income, you look at the assets, you look at the credit, and then you look at the property. What
So
type
there's
of
4
property is
things.
it? Yep.
The property, the assets, the income,
And the credit.
And the credit.
Yep.
Okay.
So you look at those 4 things to get an idea of what the interest rate's going to look like, what the repayment terms are going to look like. Do you qualify? And then you can narrow down the payment.
Okay, so the question is once you look at those 4 items, is that when you make the decision to the homeowner, you're going to do an equity line of credit, you're going to refinance the whole mortgage? Which route do you take based on that, or when is that decision made?
Right after that, because you're going to find out what they qualify for, and then you're going to look at what they qualify for and include the knowledge that you have about their current loan. And then you're going to diagnose, does it make sense to redo all of it, or does it make sense to just give you a home equity line of credit or a home equity loan or a, whatever type of option you're going to look at. Once you know what they qualify for, then you can start to diagnose options.
Okay.
At that point.
And then from your experience, you'll advise or guide the homeowner as to which way, because the homeowner's going to be like, well, where do you want me to go? You know, because sometimes in a home improvement project, there's the 4 dirty words of home improvement. We might as well. And those are budget breakers. No. Those are the items that homeowners are like, you know what? We might as well do this. Do you ever give them a cushion, or is it part of your process where you say, look, in home improvement equity line, you're going to need a little bit of cushion. You're going to need some extra. And you bake it in there?
Oh, yeah. Well, at the end of the day, once you do a home equity, if you do decide to go the route of a home equity loan, once you get the loan, you got the loan. But to add an extra $10,000 cushion, that's not a huge payment breaker, So if you have a little extra cash,
what if they don't use the money?
Well, they can always put it back and reduce the amount of interest.
You know what I tell my clients, Chris? You know what I tell my clients when I ask them their budget, and every contractor that's listening to your show, a lot of contractors do, I know that. If your budget is $100,000, make it 120. Add 20% to whatever you're doing.
Because the reason is for latent defects. What, in your opinion, I know the reasons myself because I've been doing it, but what are your reasons?
I'll give you my reasons. I'll give you one reason. I've done construction. You've been to my house.
Yes.
It's been remodeled. I've done the kitchen. I've done everything. There's always things that come up. Had to redo this wall, the plumbing. So, my house was built in 1948, right? Yes. And all of a sudden, there's issues. Not the pretty stuff.
Right.
Underneath the stuff.
You didn't plan.
Didn't plan. I had to because we were adding heated floors, adding a new
domino effect.
Yeah, domino effect. Then I had to get a whole new board. What do they call that board with the fuses? Fuse board?
Yeah, no, electrical panel.
Electrical panel, yeah.
Well, thank you.
You need to upgrade your panel.
I needed to upgrade my panel. I didn't know that, right?
But some contractors know that going in, don't tell you though. That's the other problem.
I don't think the
it depends on who you use.
Depending who you use. I think a really good contractor, but sometimes where you're getting the floor, there's a lot of there's a lot of people involved. Just things come up. Add 20% is what I tell my clients.
When you used to do renovation loans, those aren't quite as prevalent anymore. They become increasingly more difficult to get your hands on. And they're listen, just doing a home equity loan or something's a way better option.
Is it easier for everyone?
It's easier for everybody. You don't want to go through draws and re-inspections. That's a mess. But my point was, if you look at the renovation loan guidelines when they used to be a little bit more prevalent in the market, they force you to build in a 15% margin of error. What happens if your contractor gets hurt? What happens if they walk off the job? I mean, not even just the things that come up in the house.
What about if you fire the contractor?
And they already got your money. Like, you never know what can happen. And if you're in the middle of a renovation, your house is torn apart, and something terrible happens.
That's a good point.
You want to not finish the project? No, but you don't want to be scrambling for money either.
Yeah.
So
okay, well, that's fair. It's a fair assessment.
Brian says 20. A renovation loan by definition will require 15%. So you should always budget
contingency
fee.
fee.
Contingency fee. Yep, exactly. Yep. And if you don't use it, you can pay it back to the loan. It doesn't lower your payment, but it cuts time off the back end. And if you do a 30-year loan, you got to pay an extra 15 grand back. Knock off some years from the term.
Let me ask you a question. If rates currently for a 30-year with decent credit is 6%, let's just use that as an example.
Sure.
Homeowners at 3%. And they're doing an equity line of credit and all that works. How important or how impactful is the decision made on the refinance or the equity line with you guys saying, Mrs. Jones, Mrs. Homeowner, we know that in the next 3 years rates are going to drop. Do you plan on a drop in your decision today? Or do you just you say if it drops, we're all golden. However, let's not make that impact our decision. Let's base it on the facts today. Let's make the best decision today. And if rates go down, we're lucky because we can always monitor the homeowner and refinance
always
again.
will.
But if the rates go up, we've locked it in and covered everyone's butts. Is that a good way to look? Is that a strategy? Or what do you do?
It's a great question.
I've been doing this for 30 years, and I still can't tell you what rate's going to do. You put 100
You don't
economists.
have a crystal ball? I thought Rocket is the crystal ball.
I've got an 8-ball. You put 100 economists in a row, you ask them the same question, you're going to get 100 different answers. Swear to God. But
so basically, you're making the decision, and you're giving the advice to the homeowner based on what's best for them today.
Everybody's home is like
it's their castle.
It's their hole.
Yeah.
Like a caveman had their cave, their hole. It's everybody, and they treasure it.
It's their comfort zone. It's their
let's say the word.
biggest
Let's say the
investment.
word. Let's say the word together on 3. We're going to say home. 1, 2, 3. Home. Doesn't that sound good? Right? Everybody wants to be there. This is your castle. Renovate it. Make it happen. Do what you want to do to it. Because you're there in the morning. You're there at night. You're there with your family. It's where you want to be.
Your house is your biggest investment. You have to take care of it. You have a responsibility.
I think we were talking about, what did you say the words about, you said some very meaningful words, like some Confucia type of stuff.
Like what?
About
regarding
when we were talking about homes and financing improvement product.
We might as well.
No.
4 dirty words?
No. I don't know. We'll come back to that.
It'll pop to your head.
But everybody's mortgage in their house is like their fingerprint. Everybody's got a different one. Everybody has different goals, right? So when somebody, like I had a client the other day, they owed $60,000 on their mortgage, and they were at like 2.875, right, on a 15-year, and they're building a lot of equity, but they wanted $300,000 to fix up their house, and they couldn't shake the idea that their $300,000 was going to be at 8.25, but that they couldn't get rid of that. I was like, we gotta just you got to forget about that. We got to put you in a 30-year fixed at like 6.25 instead of you taking a higher amount. But they couldn't shake that low interest rate.
That's the blended rate we're talking
That's
about.
the
If
blended
you got
rate
a
we're talking
60
about.
grand loan that's tiny at
But
a
it's
good
up to,
rate.
in my opinion,
Yeah.
based on your experience and being professionals in this industry, that's your responsibility to me, the homeowner, to define that,
Yep.
explain that, and make it so that I understand exactly what I'm signing for, what I'm doing, and saying, listen, your 2.1% mortgage is going away. You're now at 7.5%, but you're blended and you're much better ahead,
Yeah.
and you're farther ahead because of this.
Adam, the easiest way to explain that, and this is how I do that math. I pull out somebody's credit report. I find out how much longer they have on that 15-year loan.
Sure.
And I look at their principal and interest payment, and I just multiply it by how many months they have left, and then I give them the 8.25, 8% or whatever.
I would do the same thing.
And I just multiply it over 360 or 200, whatever the term is, and I say, if you keep the two, here's the total payments you're going to make on this one. Here's the total payments you're going to make on this one. I have another idea. Let's put them all together at 6.25. If we do that math, here's your principal and interest payment at
And you're
6.25.
Circle the
pay
one you
less.
want. Circle the one you want.
360 payments. Which one would you prefer?
Okay, so there it is.
Easy.
You have just put the light bulb on for the homeowners.
Yes.
If you find a professional, friends, who are going to walk you through the process of getting the proper financing for home improvement, they're going to show you the options, and it'll pop out on the page which the best way to go is.
Yeah.
And now, let me ask you this. I've got credit card debt I want to pay off a little because that's at 28%, 29%.
I hate credit
Oh,
card
God,
debt.
yeah.
I hate it.
Can you do that?
Oh yeah.
So you
Yeah.
can mix other bills with the line.
Well, back when I started in 07, 08, and then 09,
Debt consolidation was big
that was
time.
one of the biggest things you used to do. Dave Ramsey was really catching fire back in the 2000s.
Cash fast when you need it most.
The snowball. You know, he would talk. Everybody was talking about the snowball, and what we would end up doing is we would show people, you know, a cash out opportunity. We consolidate a bunch of their credit card
Right.
debt, and then instead of just taking the savings, we would say, how much savings do you need per month to make you feel more comfortable? And he said, listen, if I could just drop my expenses $500, like it would give me
Yeah.
some breathing room. Well, if I'm saving them $1,800 in credit card payments, I'd say, okay, you take the $500 to feel more comfortable. We're going to take the $1,300, and your minimum payment's $700 on this loan. We're going to pay $1,300 on it. And you could show somebody, look, if you just do that, you're going to pay the whole 30-year loan off in 6 years or whatever the
Done.
math
I would
was.
love that. Have you ever heard of those accelerated mortgages? You know, they're like, they're not
Yeah.
rocket, but they're like, have you seen that? There's like, I've seen some videos on if you do this and you do that. It's confusing, but at the end of the day, there's people that say, oh man, I paid my mortgage off in 7 years.
Bottom line is if you're paying 18%, 20%, 28%,
What about the jump game?
it just boils down to how can I reduce those expenses and the interest, most importantly. Because if I can reduce the interest, then we can create more principal. That part's simple.
Okay, so there's ways to do that. Now, how impactful is the future value? Now, if I put $100,000 kitchen addition on my house, okay, I've added square footage and I have a brand new kitchen. Now my house appraises much higher. And according to Remodeling Magazine and the Cost versus Value report, that improvement gives me 85% return on investment immediately or greater. Do you guys do you guys take that value in consideration with the loan, or is it just that's an added benefit?
You know what? I think what we're missing here is memories. And there's a quote out there
The
that I
world has
heard.
a short memory. We know that. History
No, the
repeats
memories
itself.
of the enjoyment of the remodel and everything you're going to have. There's a quote that I
It's
heard.
priceless.
It's priceless. The business of life is the acquisition of memories, right? You know,
The business of life is the acquisition of memories.
that's a quote I heard, and I liked it. I forgot who said that quote, but memory dividends is what it's about.
Yeah.
You know-
remodeled your entire house.
I mean, can I tell a story? Can I tell a story about a remodel?
Please tell.
So I had this old house. My wife and I purchased it back in 2005, and it was total remodel. I mean, the windows were still metal. you feel a breeze in the wintertime. And we had this big bathroom with one of those, I think it was remodeled, had to be in the 80s, because it had one of those big jacuzzi tubs. The hot water tank wouldn't even fill the tub.
Got it.
Right? It'd go halfway, and then I'd get teapots to pour the water in to keep the hot water going. It was a joke. And, my father, born during the Depression, the most frugal man you ever met. Most frugal man you ever met. Love my dad. 93, his birthday's tomorrow, actually.
Happy birthday, Dad.
Happy birthday, Al Baumann. So anyway, once a week we'd have to bleach the shower because the grout would get moldy. I hate grouty mold. It was terrible. I had a heater in there to keep I had carpets everywhere because the floor was cold. And, being brought up, my father being as frugal as I am, I didn't want to do anything. My wife was miserable, just miserable in this bathroom. My father was like, what are you doing? You work hard. You wake up. This is from a Depression era telling me to make a move. And you wake up in that bathroom, you go to bed at night. Every day of your life, you're working hard, do this. So we did it. We jumped in.
You regret it?
Oh, my God. I was like, I regret not doing it sooner.
Okay, there you go. So let me ask you this.
I regret not doing it sooner.
Do you remember? See, right now you're like, oh, I love my house. And I've been there, and for everyone out there, it's beautiful. It's well thought out. It's well planned. The quality is impeccable. But during the process, were there times that you were just pulling your hair out? Were there times you were fighting with your wife? It was just, did you want to fire the contractor a couple times?
Everything you just said.
And then some.
And then some.
But now you're like, oh, it's so great.
I mean, it's incredible.
Can you put a value on the enjoyment of this?
That's what I'm talking about.
The enjoyment factor.
The enjoyment factor. Priceless. Do it. And what we're seeing now, ever since COVID, is when interest rates were really low, people would be moving up. Well, now you can't move up anymore because the house that you paid $300,000 for is $500 or $600. Right. So people are staying.
Since post-COVID, people have cocooned, have
staycations, worked at home,
right, and working from home. So that's fueling the renovation.
It is,
and the renovation business needs that boost for people to get banking and financing to pay for more renovations because the pricing has gone way up. People don't realize how expensive it is to renovate today. And you need to get financing. But to get financing, you need the right financing. That's why you guys are here, so that we can put homeowners on the roadmap to success. And that starts with getting the right finance project.
And get the financing before you start thinking. Correct. See what the payment's going to be. See what you're comfortable with.
One of the biggest...
fix it. Make sure it's fixed.
One of the biggest mistakes I found during the COVID times is I would talk to folks that were getting ready to sell their house. And then they would do all the projects that they wanted to do. So they
my God, you're so right.
How many times have you seen that? That's another
thing.
So
you live in like the dirty bathroom that I have. Oh, I'm going to sell. Let me fix it up.
I got to fix the bathroom up so I can make as much as I can on the house.
Oh my God.
I ran across that a lot, and when I start talking to clients and they start thinking about renovations and things, and they go, I don't know, we're probably only going to be here for 5-6 years. I don't know if I'm ready to do my renovation. I go, would you rather renovate it for somebody else, or do you want to renovate it now and enjoy that new kitchen, enjoy that new bathroom, enjoy that new backyard for 5 years, and then sell it? I go, just if you aspire to do this, just do it. Do it. Enjoy it yourself. Don't do it for somebody else.
It's actually really good advice. Let me ask you this. Homeowner, regardless of what lane they go down for financing, whether it's an equity line of credit, a new mortgage, and just paying everything off, whatever it is, from the day they call you to the day they get funded, what are we talking? We talking 30 days, 45 days? Are we talking a week? Where are we at? And with
20?
With the automated process?
I would say the average is 2 weeks to 3.5 weeks, depending on the person's situation.
Because the homeowner has to get a lot of information to you.
Yeah, you can close as fast as 2 weeks, I would say. That happens quite a bit. And we don't see many refinances last longer than 3 weeks or so.
No, Rocket's
pretty quick. What information... For everyone out there says, I got to call these guys. I want to do this. What do you want them happy? What do you want a homeowner have with them ready, prepared when they call you? Anything? A W-2, here's what I make. Do I need to know my credit?
I think it's simple. If you're a salaried employee, W-2 and 2 W-2s and a pay stub. If you're self-employed, 2 years of tax returns.
Yeah.
And if you're a corporation, business tax returns.
Okay,
have
you
it
make
simple.
it sound easy.
Have
But
it
I'm going to
handy.
be honest with you. I know a lot of homeowners who get anxiety when you ask them for a W-2. They're like, what's that? You know, or they get auto pay, or they're like, tax returns? I don't know. I have my guy do it, and it's automatic electronic. Where do I have to find it? I don't have it I used to have like a manila envelope. Now I don't have anything.
Most employers have an online database where you have to, if you get auto pay, you always get a pay. They have to give you a pay stub.
Right.
But it's usually on an account. Like a lot of companies will use like a Workday or it's ADP or any one of these.
You can get the pay. You can get it digitally.
You can get them. So if you know how much you make, and you know it, as long as you have the knowledge, that's enough for the conversation. But if you can get a pay stub, you can get some that's great.
Let me ask you another question. Homeowner gets a hold of you, and you're going through the process. Out of 10 homeowners, and I'm just giving the number, how many end up calling you and saying, are you calling them and saying, you know what, you have a charge off, you have a late pay, and they have no idea, like mistakes on credit?
That happens.
How often is that? If you have 10 homeowners in a row, is it one homeowner or is it 5 homeowners, or is it what is it? 30?
1 out of 10?
Maybe. I mean, I don't know that there's too many of the
so it's not as
surprise
prevalent.
collection, but it definitely happens.
Oh my,
Yeah.
I mean, credit card in my hand. I never heard of this one.
Yeah, I mean,
my favorite one. My favorite one is when you go to pull the credit and the husband doesn't know that the wife has been making all these charges. What do you mean I have a Neiman Marcus $10,000? What are you talking?
How do we get $5,000 on Target? Everything's
I don't own it. Wait,
Finger Hut. Finger Hut's the best one.
Finger Hut. What's Finger Hut? Yeah, no, that's funny.
Yeah.
You know what? Listen, it's an interesting because it gives you a glimpse into what people are like.
I'm going to go back to my father. You ever hear the expression? You can always tell a person by the shoes they wear. You ever hear that expression?
Uh-huh.
I was like, Dad, you got to pull their credit. You really want to know a person? Pull their credit.
Yeah.
Really, it gives you it gives you a picture.
Oh my God! Yeah.
What's considered, by the way? What's considered good credit?
Anything above 700, I would say.
Yeah.
Anything above 700.
Fair to
so
good.
700 is considered good, fair.
I've always
700. I think anything under 700, you get a C. BA above 700.
I've always told everybody the flip where you go from fair to good is 680 to 720. Like that little window is kind of where you flip.
I'm telling you, but that 680 to 7, that could cost you.
Oh yeah, 100%. That's the fair. That's the fair side of it.
What if you ever give a homeowner advice and say, listen, you're at 680, but I can tell right now from your credit report, you paid this one off and make a payment here, and next month when is it monthly the credits get reported?
60 to 90 days.
It depends. It's different for every company, and they don't report based on your billing cycle. Sometimes they report randomly throughout the month. Bottom line is, if you're going to go and you're going to be applying for credit, I don't care if it's a car loan, house loan, doesn't matter. Pay all your credit cards under 10%. Don't pay them to zero. Leave them there.
I would say 50. Keep the balances to the limit at 50.
So wait, I have a $10,000 limit. Keep it under 5,000.
There's 3 levels. Under 50. If you're over 50% on your credit card utilization, you're getting hit, and it compounds. It gets worse every month. You're over 50%.
So pay them down below 50.
Below 50 is step 1. Below 30% is step 2. And the best place to be is to have your utilization under 10%. That's the best place to be.
For the highest credit score.
For the highest credit score,
so
not zero.
$5,000 credit limit on a credit card. Yeah. I should owe less than 500.
Yes.
Ideally.
But
if I have 2,200,
you go to dinner and a movie, it costs $500.
Well, pay it down and don't use it for a month.
Yeah.
You're going to. We're talking about preparing. If you want to prepare to finance something, whether it's a car, house, whatever, and you pay your card off every month, I would be aware of when they report. And I would just make sure the balance when it reports is under 10% if you want the best possible outcome. And contrary to popular belief, having your credit cards actually report at 0 isn't the best because it doesn't show you're using it. Okay. Put $10 on it. Go get a cup of coffee. That's it.
I wasn't sure, and that's why I asked.
Say, Adam, can I say something? There's 3 things. There's 3 things that coexist with the best deal. There's 3 things. Better the credit, the better their deal. Better the credit, the better their deal. Better the credit, the better their deal.
Is that true?
Is that true?
Oh, yeah.
Okay, so
those are the 3 things.
The better the credit, the better your deal.
Better the credit, the better the deal.
Okay. Say that 10 times fast, right?
No, 3 times. That's all you got to do.
Okay, so for everyone
Then
out there,
then a mortgage genie pops up.
yeah,
BCBD.
right?
Yeah, and then
The
then you
better
get
the credit, the better their deal.
Yep.
Yes.
better the credit, the better the deal. Mm-hmm.
Okay. Well, that's important. And
Yep.
okay, so there's where we're at. All right. So now, what about the homeowner who's a 1099 or they're a salesperson or they don't have consistent income? They got money, decent credit, but they have to go out and hunt all the time for income. They're not just getting a salary. What does that do to impact?
We have
There's options.
There's definitely options.
Yeah,
If
there's
you want to do this, call us and let us figure it out.
Well, look at
whether
the
you're
tax
1099,
returns.
self-employed, you're not working, you're retired.
Yeah.
Let's look at it.
Yep. If you're
Have a
self-employed, like you
conversation.
said,
The better
there's
the credit, the
options.
better the deal.
But,
Yep.
yep.
That's true.
We look at tax returns. There's also for self-employed folks where we can look at your bank statement, cash flow, and make decisions on that. There's options. There's definitely options.
And our retired folks out there that haven't even started Social Security, they call us up and they think they can't do anything, but yes, you can.
Yeah.
We
can talk to you
there's
about it.
options, but you have to have credit.
Yeah. Yep.
That's the first step.
It's 2026.
We have a team out there, don't we? What's the name of our team that helps people with
Yeah,
credit?
we have a credit team. They're credit
credit
experts.
repair.
How many people are working at the credit experts? 100? 50?
I don't know. There's a decent amount. But one of the reasons I've learned about credit is because one of my good friends over there runs one of the teams, and him and I have done conversations with realtors and all kinds of stuff where we've actually taught people how to
There's
manage
no
their
magic
credit.
trick to fixing your credit like you see on TikTok.
No. You
What about those groups that say, "Yeah, give me $500 and I'll fix your credit"?
That's illegal, right?
No,
There's people that
won't-
they take advantage of people.
I won't throw the names out there, but I mean, there's
Don't
a lot
do
of
it.
the credit repair.
Anybody that wants
places.
money up front to fix your credit,
There's no back
don't
door.
do it.
No, a lot of times they bully your creditor by not paying them. So you think they're negotiating. What they're doing is holding your money back, racking up late payments, and then trying to push the creditor into negotiating a lower balance. So, yeah, they might negotiate it down
I see what you're
30%, 40%. You could have done the same thing yourself.
Yeah.
You can usually call and negotiate it yourself, and sometimes you can negotiate with collections and stuff. What's called a pay for deletion. I'll pay you if you delete.
Can I give your audience a tip?
I would like you to. Yes, please.
So let's say if you're paying credit card debt, if you have credit card debt out there, let's say you have a Visa or MasterCard, you're at the maximum right now, you'd call up your credit card company and let them know you're having a hardship. That's the key word, hardship. Say you're having a hardship and you need some relief. I need help. I'm not going to be able to make my payments.
By saying that, though, does that affect their credit?
If you miss a payment, you are.
But you could be hardship and tell them you need relief, but still making those payments.
So it doesn't happen all the time. But if they tell you no, say I want to speak to your manager. Because usually the first stamp is no, just like an insurance company, deny the claim. So go to the credit card company, say I'm having a hardship. And so the interest rate's at 26%. And how come nobody's telling? Everybody bitches about everything, but nobody bitches about the credit card companies charging 22% interest. How come nobody complains about that?
22 is low.
That's
28,
low.
29 now.
Yeah. That's like mafia rates.
So
like
what do they do?
usury.
They
Anyway,
can lower it?
so what they would say, look, for 12 months, we'll
Yeah.
bring this down to 8%.
Okay.
And
that doesn't
or
affect
12
your credit?
That would
As
not
long as
affect
you
their
continue
credit.
to pay
as long as you
everything.
continue to pay.
Yeah.
So, but that, the one thing you don't want to start doing is I call it the jump game. A lot of clients would say, "Oh, I got a 0% interest." Then they go to another 0% interest. I call it because then they start charging you to transfer that money to another thing.
Right.
You start opening up these other credit cards. Your credit score goes down. Then when you want to get a mortgage, you're not able to because the credit card's it's too low.
Yeah.
So if you're having a hardship, that's or having some credit card debt, call them up and try.
Make the phone call versus not paying,
Yeah.
or choosing which one to pay.
Have a conversation.
You're better off having
Negotiate.
not to
And
defend
people are scared
homeowners.
to negotiate.
But not to defend homeowners. I think sometimes they get paralyzed.
yeah.
And they get anxiety and they don't know what to do. So
100%.
That's what
100%.
happens. So
Yep.
It's overwhelming.
Yeah.
Overwhelming.
So let me ask you guys a question. It's 2026. What's the professional outlook? What's your prediction from the industry veterans in the mortgage business? You guys are like the pros. You're the people that everyone measures themselves against.
I got
Are
it.
you talking?
I got
it's
it.
going to be a stellar year.
I got it.
If
I
you're
got.
thinking
I know
of-
what I'm going to answer already. I'm going to let Chris go first, but I know what I'm going to say. I know.
Yeah. Okay. Well,
Well,
Chris,
yeah,
I know what I'm
I can
Chris,
tell you.
tell me your thoughts, and then let's round it off with Brian.
Well, there's a couple things. So right now, just our team's level of pre-approved clients who are looking for new homes is up about 30%.
Looking for new homes, and they're not abundant new homes.
And
right
it's
now.
it's up
Low
30%
inventory.
over last year. So
Do
if
you
we
guys
can,
work with real estate agents?
Oh,
Do you
yeah.
have a
That's-
bunch you refer to? Or do they refer
that's
you?
actually how we do business.
Yeah,
That's
yeah.
the number. We don't take business from Rocket. We create our own. So our business model is 100% referral. We do something a little bit unique for the company. So we
Local.
don't. We're local. Exactly.
Tell them about Rocket
We're-
Local.
We're bringing it back to the original way that we used to do business.
In
and we have a
1996.
group. And we have a group of folks that
OG group?
OG.
Yeah.
My
you
group,
have to be
my
senior to work in this group.
Yep, my group and a local group of us. Now we're up to 400 people in our division, but we have people all over the country that work locally within the market, face to face,
And that's Rocket's footprint.
and we build relationships with industry professionals, and we help their clients through that relationship. But our team's approval levels are up 30% year over year. So there are people who are out looking to buy, and one of the things that people do as a knee-jerk reaction to answer your question is they see interest rates and they see home prices and they say, oh, you know what? I'm going to wait until rates go down.
All the time. What are they
We've
waiting
been
for?
talking about this for over a year since rates went up in 22, and we've tried to tell people when rates go down,
You're screwed.
the bubble will burst, and all these people who have been waiting to sell that are at 3% are going to finally decide to get in the market when the rates are in the fives. Like, okay, now I can stomach, a move. You're going to have all these people who are new homeowners who have been sitting on the fence saying rates are too high, I don't want to buy. Everybody has made their decision based on rates. Instead of, can I afford it at 7%? Can I afford it at 6.5%? Does it give me a home? Does it change my life? That's the way they should be making decisions. But a lot of people have sat on the fence because of interest rates. When that stops, there's going to be an influx of demand into the market. And every house that goes up to list, that's a new home on the market, that's another buyer that's in the market too. So it doesn't create more inventory, but it creates more demand.
Sure.
So-
And here's a little statistic to add to that.
Yeah.
There's $500 billion a year spent on home improvement, give or take. 80% of all home improvement dollars are spent in the first 18 months of home ownership.
Yeah.
Really?
How about that?
Yeah, I believe it.
So that's a big statistic that helps complement what you just said.
You move in and make the house exactly the way that you want it. It definitely makes sense. But
Yeah.
so I think now we're at a point this year where a lot of the people out there have started to realize, you know what, rates have come down some.
Sure.
And I think the message is starting to get out there. Listen, if they go too low, everybody's going to start getting into the market. So I should start trying to find the home I love before it gets too crazy.
If you guys get really busy and rates start dropping, are you guys prepared as a company to handle any volume?
And wait a minute. By the way, when rates do come down, our clients that I've worked with that get called first.
Yeah.
So that there's a priority.
They're their priority.
Yes. But to answer that question, we experienced some of the biggest growth we've had as a company through 2010, 2011, 2012, because a lot of the larger institutions couldn't handle the volume, but because of the way that Rocket does business,
Yeah.
we were able to actually absorb not only our incoming business,
You were helping others.
but without naming lenders, we had
Name them.
we won't. But I've had we're talking some of the largest banking institutions in the country used to send us live client transfers because they couldn't handle the volume of business.
And they would, okay, so that, listen.
So they would
you
call
were able
us
to
and
do
say,
that. That's nice to know.
They would call
Yeah.
us and say, hey, so-and-so at Rocket, this is so-and-so from this other large bank. I have so-and-so on the phone looking to do a refinance. They're in Michigan. Are you ready?
If rates drop in the process, at the closing, does the homeowner get the lower rate always? Or is it you lock it in,
You have a choice. You lock it in or you float it.
Yep. But
Lock
we
it in or
always
float
watch
but
it.
it could go up if you float it too.
Once
does.
once you lock it, that's it till closing. Now after you make a couple payments, we monitor it
How soon can you refinance again if the rates are dropping?
as soon as possible.
But is it 30 days, 90 days, 6 months?
Technically, you
Two
can do
payments.
it. Technically, you can do it whenever you want to.
Okay.
There's no
But
prepayment
there's a lot of
penalties
cost
ever.
of the paperwork too.
Yeah, that's true.
Well, we
you
have
roll all that into a loan.
Listen,
It's got to make sense.
the likelihood of you going from 6.5 to 5.5 in 2 months, that doesn't
Not in
happen
this
very
market.
often.
Okay.
But we watch it, and at the point where it makes sense, we'll reach out to you. If you have $1 million loan, you take a quarter point for free. If we could do a loan for you for free, you take $200-$300 a month. So there's no magic number. It's based on what you owe and how big the rate drop is and what the costs are. But for us, anytime we talk to a past client, we say, how long do you plan on being in this home? And then we can look at the cost versus the savings over the time that you plan on owning the home and say, if you will be there for 5 years, it'll cost you $2,000 or $3,000, or it's different for everybody, but here's the cost. You're saving $2,000 every year over 5 years. That's $10,000. It cost you $2,000. You make $8,000. It makes sense. It's easy to figure out the cost benefit analysis when you have that conversation.
Right.
Let me ask
Good
you,
point.
Using your home as a checkbook. I don't recommend it, obviously, but I want to fix my house up. I haven't decided exactly what I want, but I need to call you first. I need to know how much I have to spend.
Yeah.
Is that a doable option for me to come to you and say, listen, I need a furnace. I'm going to do maybe a kitchen. I know I need a roof because the insurance company just called me, but I haven't decided how much. So I need to maximize what I can borrow against the house. Can you give me the max? Can you guys work with me on those numbers?
Most definitely. I also feel that if you own your house free and clear,
Yes.
for the clients that are out there that are lucky enough to own their property free and clear, and if you do, congratulations. I think they should get some type of equity line on the property, or something that would
Almost like a checkbook.
almost like a checkbook. Now, for the person that can't control their spending, not a good idea.
So is it risky? You gotta be careful.
If you're spent,
You have to be disciplined.
You have to be disciplined. Usually, people that have their house paid off are, right? Let's face it.
I wouldn't know that because I'm not. I'm not that person.
But what I mean is, it's a great way to have quick cash. You want to buy a car, you want to do something. You're not selling assets to pay capital gains on because you don't pay taxes on home equity.
On loans,
Right.
yeah.
You get a tax write-off on home equity. So it's a good thing to have. A lot of people get scared of having that, but I highly recommend, just having that as an option.
Let me ask, for someone who just bought a home and doesn't have much equity yet, but wants to start improving their home, what financing tools do you recommend that would help them?
If they don't have equity, they need to, my best advice is you need to grin and bear it and go make the money. You need to save up, you need to figure out what you need to do, because there are not a ton of options out there unless you get into the renovation loans. And if you,
Okay, so when you say save up, what if my mortgage payment's $1,000 a month, and instead of saving money, I start paying $2,000 a month?
you can
That's
do that.
saving money by also increasing equity in your house. Yes. Is it more complicated?
If you
than
pay
that?
the loan down, then it creates equity that you can go back in and borrow against. But the other way to think about that, Adam, and now we're getting into the financial world, and I'm not a licensed financial advisor, but imagine you have somebody who's young and they're putting 5% into their 401k. Why don't you if you can afford $1,000 a month, put $1,000 a month in your 401k that you can borrow against later, tax free. There are different ways
when
to.
you pay down a mortgage and you put extra money on your mortgage payment, do you have to tell them that the extra money goes to equity?
Yeah.
You have to. How do you specify that?
Well,
Is it
in
like a little note?
In our online account, when you make a payment, there's your basic payment, and there's a little box underneath that says extra principal. So if you want to pay an extra $1,000, you just throw it right in there.
Okay.
And that goes right to principal versus being credited towards a future payment.
I think it's nice. I think I always tell, especially my younger clients, take your payment, divide it by 12, and add that every month.
Okay.
Bi-weekly, extra
Bi-weekly.
payment a year.
Yeah, an extra payment a year brings it down to what? A 30-year down to 26 and a half years?
Yeah.
26?
Wow.
About 26.
That's a fast.
26 and a half.
I mean,
It goes quick.
It goes quick. Time goes quick.
Yeah.
Okay, so guys, this is some great information. Anybody watching this right now is going to be like, wow, and they need this. So let's give the listener one or two quick tips on what to do. So if they're hearing this, what's the first thing everyone should do?
Let me jump in here. The first thing you should do is call for a quick analysis. Let's analyze what you want to do. Let's talk about your goals. Where do you want to be? How much do you want to spend?
Does it cost anything for them to call you?
No. Before you do anything, let's talk about and let's make sure you're comfortable with what the monthly obligation, the monthly payment will be. Chris, what do you think?
It's 100% the case. Because if it's not the right time or you need to correct something, we can tell you what that is.
We can fix it.
And we can give you the specific way to do it.
So you'll give me the roadmap.
Oh, yeah.
which is perfect. Okay, so I like that information, and I want to thank you guys for giving this great information to our listeners today. Before we wrap everything up, just tell everyone your name and how to get a hold of you, phone number, direct line,
I'm
and then to you also, Chris.
I'm going to give you my direct line. Call Brian Baumann, 248-417-0547. I'd love to be able to service you.
And Chris?
Call Brian Baumann. He would love to help you. I'm here for support for Brian. So if you need anything, Brian's been here for 30 years. I've worked with Brian for a long time.
My partner in crime here.
I'm Brian's sales manager, but I'm his partner in crime. So if you need anything, Brian will absolutely help you.
So if anyone out there really wants to get this information, the link is in the bio. Click it below. You'll get a hold of Brian right away. Gentlemen, this is great information. I want to thank you 1,000 times right now for this.
Thank you.
I really appreciate you coming on. Rocket Mortgage. It's an honor to have you here. Such a big company, and to be you there 30 years, you there 20 years. That's a testament to the integrity and the culture of Rocket Company.
Thank you, Rocket.
Yeah, we wouldn't have it any other way. Best company in the world.
What you don't know can hurt you. Paradise.com